Okay, so in the last class, if you remember, we were talking about ISA 315, identifying and assessing the risk of material misstatement. In the class preceding that, we were talking about audit risks. And now, as I told you in the orientation session, that we would be supplementing our theoretical knowledge that you would acquire in this class with exam standard questions side by side. So it's time for us to expose ourselves to the real exam standard question. And the question that we would be doing, we would be solving today is from a relatively recent attempt, audit and assurance, September-December 2018 sample questions that were released by the ACCA. And this is question number 16. Question 1 to question 15 are objective type questions, multiple choice questions that you're supposed to do. And this is a section B question, which is question number 16 on your question paper. So let's first go through the requirements. Always remember, an exam technique, you should always be reading the requirements first and then moving on back to the scenario, because reading the requirements carefully in advance improves your focus. You're able to focus exactly on how you would be tested in an exam, or what is the focus of what you need to look for in a scenario. So you need to have the right focus. And for that matter, reading the requirements first is the key. So here comes in the requirements. For the time being, we would just be focusing on requirement B, requirement C, and part of requirement A. Part of requirement A, not the full requirement, but part of requirement A only. So let's start off with the first requirement. We will not be focusing on requirement D and E. You would see describe substantive procedures, describe substantive procedures. You haven't heard of substantive procedures to date. We're just not focusing on these, just focusing on the first three requirements. Requirement A is explain why analytical procedures are used during the 3 stages of an audit. Now, you've heard of analytical procedures. You've all heard of analytical procedures. We haven't covered them in all the 3 stages, but we've covered them in one of the stages. So, okay, let me help you on this one. Analytical procedures during 3 stages of an audit. Now, let me take you back to the notes. In yesterday's class, we covered ISA 315, identifying and assessing Rome to understanding the entity and its environment. And over there, we saw analytical procedures as risk assessment procedures to identify red flags, to identify unusual trends, unusual relationships. So the simple answer to this question is, for the first part, the part A, we're just partially answering this, but that's fine. Analytical procedure, I would summarize it. AP is used as a risk assessment procedure in the planning phase of audit to identify unusual trends, relationships, to assess Rome, the risk of material misstatement. So you see, brief and crisp, one-liner. It's used as a risk assessment procedure in the planning phase of audit. What is the purpose? To identify unusual trends or relationships to assess the risk of material misstatement. I hope you're happy with this. There are going to be 2 other points for you to get these 3 marks. For you to get these 3 marks, there'll be 2 other points, but because we haven't covered them today, so we're just focusing on the aspect that we've covered. I hope this is clear. So this is a knowledge-based question. It's a recall question or a test of your understanding of the concepts of auditing. So let's move on to B part. calculate. So here calculations are required. So you need to have a clear ability to calculate in your examination. You would be attempting this question. There's going to be a computer-based exam for you. So you need to know how to use Excel in order to excel. Calculate 3 ratios. Now you have to calculate 3 ratios. So please be very, very careful on the number 3 ratios. For both years, you have to calculate ratios for both years, which would assist you in planning the audit of Darjeeling coal. So we would have to go back to the scenario to see what sort of ratios we can calculate. Naturally, you would have to go to the financial statement extracts for that, because it is from here that you can calculate ratios. So that matter, now let me open an Excel sheet from where you could potentially have a look on the ratios that you need to calculate. So if we go back to the question, this is the question, and we need to calculate the ratios. So how would you do that? If you look at the financial statement extracts, you would notice that we can calculate, we've been given. So what sort of ratios can we calculate? We first have to determine what ratios we would be calculating. So maybe we could calculate the gross profit margin ratio. We could calculate the gross profit margin ratio, GP margin ratio. So we could calculate the GP margin ratio. Now, how do you calculate GP margin ratio? It is gross profit divided by revenue. Gross profit divided by revenue. You have 2 years, 20x8, and you have 20x7. You have 2 years. So how would you calculate them? You need to have the gross profit. In order to calculate this ratio, if we could just quickly populate the data over here. So you would have to have gross profit and you would need to have revenue, right? So if we copy paste the gross profit and the revenue from here, 7410 6190, 7410 6190. So you have these numbers over here. Nice. Have the revenues 19850, 16990, 16990. So you have these numbers. Gross profit ratio is gross profit divided by revenue. So you have this ratio calculated for 2008. You can copy paste this to 2007 and you have this ratio calculated for 2007 as well. Then what else you could calculate? You could calculate the inventory days. You could calculate the receivable days because you have the receivable number as well. You could potentially calculate the current ratio. So inventory days is inventory divided by cost of sales multiplied by 365. What is the calculation of receivable days? Receivables divided by revenue multiplied by 365. Current ratio is current assets divided by current liabilities. So you have all these formulas. You have the formula over here and you have the ratio. Now for inventory days, what would you need? You would need to have inventory number. What else would you need? You would need to have the cost of sales. So let's have the inventory number. Inventory number is 1850 and 1330. 1850 and 1330. What about the cost of sales? 12440, 10800. 12440, 10800. So this is your inventory multiplied by 365 divided by your cost of sales, and you arrive at your inventory days. Just copy paste this formula, you arrive at your inventory days for the prior period. Similarly, for receivables, you would first need to have the receivable number. You would need to have the receivable number. Now, with the receivable number 2750, 1780, 2750, 1780. So you have these numbers with you. Now, what is the formula? Receivables multiplied by 365 divided by the revenue, which we've already populated. So we arrive at the receivable days number, 51 days. If that is, receivables take 51 days to pay. Current ratio. Current ratio, you need to have your current assets and your current liabilities. Now, you have your current assets, that is your inventory, trade receivables. Bank is a current asset, but in 2008, 2x8, it is negative. So that would effectively be a current liability. So for bank, if it's a positive balance, 2008, it's actually nil. And for 20x7, it is 560. Bank overdraft, which is a liability, is 810. And your trade payables number has also been given to you. So your trade payables number is 1970 in 20x8 and 1190 in 20x7. So you have these numbers worked out. Now for current ratio, you have to have current assets. So what are your current assets? Inventory plus your receivable plus your bank. And for current liability, this has to be divided by current liability. So you have bank overdraft as your current liability, and you have your trade payables as your current liability. And you work out, or you determine your current ratio. So you've worked out your current ratio as well. You could also work out your quick ratio, and how would that happen? That would require, quick ratio is, by the way, also known as acid test ratio. It excludes the least liquid current asset, that is your inventory, which is calculated as current assets minus inventory divided by your, current assets minus inventory, and number is divided by current liabilities. So what all you have to do is you have to add your current assets and just exclude inventory. So practically you just have to include receivable and bank. You won't include inventory in this case, and you would divide it by your current liabilities, which are bank OD plus trade payables and you determine your quick ratios. So you've calculated how many ratios? You've calculated 5 ratios basically. You see, you've calculated 5 ratios. You don't have to calculate 5 ratios. You just have to calculate any of the 3 ratios. So I hope you're happy with the computations that we've just performed. just see over here, you could even add payable days. And how would you calculate your payable days, or how would you determine your payable days? That would be payables divided by your cost of sales multiplied by 365, and simply arrive at your solution. Simply payables, where are your payables? Here are your payables, divided, multiplied by 365, divided by your cost of sales. Scenario is over. So these are all the ratios which you've worked out. I hope there's no ambiguity in the computation of these ratios and you're happy with them. You've already covered them in your earlier syllabuses as well. For example, the F5 exam, the performance management exam, the financial reporting exam. So you should be happy with this. Even if you're not clear, all you have to do is just memorize these formulae and you will be clear on this. So again, this represents easy marks on your exams, right? So you have calculate 3 ratios for both years. We've done that. Easy task. So explain why the first requirement, easy. The second requirement, easy. Now let's move on to the third requirement. Using the information provided and the ratios calculated. Information provided, here's the information that you've been provided. There's all the information, plus the ratios that you've calculated in this B part. You have to use this information and the ratios to decide, to describe 8 audit risks and explain the auditor's response to each risk and planning the audit of Darjeeling Co. For the time being, just ignore the requirement beyond this audit risks word. Assume as if the requirement is just describe 8 audit risks. We would just be focusing on the first portion of the requirement for the time being. Look at the requirement verb. I would want to clarify at the outset that you should be very, very sentimental and emotional about the requirement verb. The requirement verb is describe. It means just merely copy pasting relevant information from the case study scenario would be of little or no use. You would have to describe the risk. What exactly is the audit risk? So let's go back to the requirement, to the scenario, and now let's start going through this. So you see, for the first two requirements, we did not even read the scenario carefully. We just focused on the requirement and we started answering those portions without going into the details, into the nitty-gritty of the scenarios. So that is the importance, that you start earning marks right in the beginning of the exam by having a focused approach, that is first going through the requirements. Now we will be talking about audit risks. So now when we would be reading this case study scenario, remember we would be reading it on purpose. We have a very, very specific purpose when we're reading the scenario, and that is to identify audit risks. And what is audit risk? The risk that auditor express an inappropriate opinion. And why would the auditor express an inappropriate opinion? The auditor would express an inappropriate opinion while financial statements are materially misstated because, for example, there are some material misstatements, there are risks of material misstatements, or that the auditor is not able to detect those material mistakes. So let's now go through the case study. You are an audit supervisor of Earl & Co. Earl & Co. If you're the audit supervisor of Earl & Co., that means the name of your audit firm is Earl & Co. And you are planning the audit of Darjeeling Co. So this is your audit client. So you're clear, your audit firm is Earl & Co. and the audit client, the company that you're auditing, is Darjeeling Co. For the year ending, now this tells you something. Every word has a meaning in auditing. For the year ending, it means the year hasn't ended as of now. You're standing somewhere before 30th September 2008. This tells you that audit planning begins even before the year has ended. Based on whatever information you have at the planning date, you start planning the audit. You don't wait for the year to end and then start planning the audit. This is a very important thing. So it is very important to highlight the year end very clearly. It is for two reasons. Because then if you're told of an event that happened somewhere in between the year, it could potentially be an avenue of time apportionment. If you purchased an asset during the year, then maybe you would be depreciating it for only part of the year, only from the date it has been made available for use. When it is available for use, when it is capable of operating in the manner intended by the management. So only then its depreciation would start. Similarly, if you're told of a date after the year end, then it could potentially be an adjusting or a non-adjusting event. So it is very important for you to clearly mark the year end date, and then whatever date comes in after that, always develop a habit of comparing it with the year end to identify if it requires time apportionment or if it requires to be treated as an adjusting or non-adjusting event. Okay, let's read the scenario further, and we would first just be highlighting the relevant issues, and then we would go back to the requirement. But while we're reading, we would keep in mind that we're trying to answering a question on audit risks. So any information that we feel is relevant to audit risk that you need to keep in mind. The company develops and manufactures specialist paint products and has been a client of your firm for several years. It means it's not an initial audit engagement because it's a client for several years. If you were told your firm is auditing the client for the first time, then there would have been certain risks that do not apply in case of a recurring audit. This is an example of a recurring audit engagement because your firm has been auditing the client for several years now. So if it's like several years, then it's a recurring audit. And not an initial audit. So you need to take note of this. With initial audit engagements, there are certain audit risks. For example, you could see an exam question where you're told that this is an initial audit engagement. Your firm is auditing the client for the first time. Remember, there's always one risk, and that is the risk of material misstatement in opening balances. This is a risk that you can memorize beforehand, easy marks. If you're told in a question that your firm is auditing a client for the first time, always mention this risk. There is a risk of material misstatement in opening balances. Easy marks. But unfortunately, in this case, you won't be able to earn those easy marks because it's a recurring audit engagement and not an initial audit engagement. The audit manager has attended a planning meeting with the finance director. So audit manager has attended a planning meeting with the finance director of the company and has provided you with the following notes of the meeting and financial statement extracts. You have been asked by the audit manager to undertake preliminary analytical procedures using the financial statement extracts. So you see, you've performed this task. When you were calculating all these ratios, you were actually performing analytical procedures. Okay, when you calculated these ratios, this is part of performing the analytical procedures. Because remember, yesterday we talked about comparison of current year numbers, current year ratios with the prior period. So when you would be doing that and using that information to identify unusual trends, unusual fluctuations, unusual relationships, that is basically a part of performing analytical procedures. I hope this is clear. Planning meeting notes. During the year, Darjeeling Co. has spent $0.9 million which is included within the intangible assets on the development of new product lines. So this amount has been spent on the development of new product lines, some of which are in the early stages of their development cycle. You've been told some are in the early stages of their development cycle. Additionally, as the company is looking to expand production during the year, it purchased and installed a new manufacturing line. So a new manufacturing line was purchased and installed. All costs have been included within the property, plant, and equipment. These capitalized costs include the purchase price of $2.2 million, installation cost of $0.4 million, and a 5-year servicing and maintenance cost plan of $0.5 million. In order to finance the development projects and the new manufacturing line, because there's a lot of things, these require a lot of financing, the company borrowed $4 million from the bank, which is to be repaid in installments over 8 years, has an interest rate of 5%. Developing new products and expanding production is important as the company intends to undertake a stock exchange listing in the next 12 months. So the company is trying or has an intention of getting its shares listed on the stock exchange. The company has started a number of initiatives during the year in order to boost revenue. In order to boost revenue, there have been some initiatives. What have they been? It offered extended credit terms to its customers on the condition that sales order quantities were increased. So extended credit terms are being offered. Darjeeling Co. made an announcement in October 2007 of its price promise that it would match the prices of any competitor for similar products purchased. Customers who are able to prove that they could purchase the products cheaper elsewhere are asked to claim the difference from Darjeeling Co. within 1 month of the date of purchase of goods via its website. The company intends to include a refund liability of $0.25 million, which is based on the monthly level of claims to date. The finance director informed the audit manager that a problem arose in June 2018 in relation to the mixing of materials within the production process for one particular product line. Problem in the mixing of materials within the production process. A number of these faulty paint products had already been sold, and the issue was identified following a number of complaints from customers about the paint consistency being incorrect. As a precaution, further sales have been stopped. Product recall has been initiated. So product recall has been initiated since June. Management is investigating whether the paint consistency of the faulty products can be rectified and be subsequently sold. These are some of the key issues that you've identified. You've already calculated a few ratios, plus this is the information that you've been given that could be potentially indicative of problems, of troubles, of issues in financial statements. Now, what I would suggest is you take a picture of this screen that's currently appearing, and you take a picture of the ratios that we've calculated. Take a picture of the screen on your mobile phones or on your computer screens. You could take a screenshot, maybe. And you can also, if you've taken, I hope you've taken this picture,